All right. Hey, everyone. It's Kirk here again at Option Alpha. Thank you so much for joining me on episode number 4 here. First of all, my apologies because this title I should have sent to them earlier, but the title of our show today is going to be Moment in Time with Option Probabilities, basically trying to use some more data and research to understand the moment in time problem that people seem to think about a lot with option probabilities, and then how we can use some of this data and some of this research to inform not only trades that we get into, but also, I think more importantly, managing existing trades that you have. How do you determine if you should keep a trade on or potentially let a trade go off? How do you use some numbers and math to help you do that? So I hope you guys enjoy this one. As always, if you have any questions, please let us know in the comments, the chat, choose an email, team@Option Alpha. You can always go back and watch the other 3 episodes as well. And I encourage you to do that if this is your first time. Go back and watch those couple episodes. You can come back to this one if you need to. Okay, so we're going to share my slides here. And so we're going to be talking about, like I said today, the moment in time problem for options probabilities. And so just as a quick recap over the last few episodes, like we've been talking about, we've looked at using expected value for your trades. And so that was essentially that first episode that we did in this series, where we talked about how we can use expected value to determine if a potential trade is potentially a good trade that has a positive expected value versus a trade that has a negative expected value. And that's going to be a key difference because generally speaking, we want to choose trades that have a positive expected value versus a negative expected value, trades that should pay out over time and have some sort of edge embedded in them versus trades that don't. And then we also looked at using alpha in the last episode to rank our trades. So is the highest possible expected value the best? Well, that depends on how much risk you're taking to get that expected value. So we can use alpha, which just takes the expected value divided by the max risk to determine what types of trades we should get into. And so ideally then we want positive expected value trades, but we also want trades that have positive alpha. And generally the highest alpha means you're getting paid the most units of expected value per risk that you're taking in. So remember, this is the expected value calculation. We're not looking at just the max profit and just the max loss. We're looking at everything, including the partial profits and losses, to determine if trades that we're entering have positive expected value. And again, inside of Option Alpha, and we'll look at this here in a little bit too, but you can see positive expected value inside the trade ideas. You can actually rank all of your trades by positive expected value. So you can find trades generally that have those and sort through the ones that don't. And then, like I said, we looked at in the last video, and just as a recap really quick, in the last video in this episode series, we looked at looking at alpha as a ranking mechanism. So we compared 2 iron condors. One on the left-hand side here, you can see is this SPY iron condor. And you can see right here, the EV or expected value on this trade was $266. The iron condor for QQQ on the right-hand side, the expected value for that trade was $282. And so the question I proposed in the last episode in the series was, should we take the QQQ trade or should we take the SPY trade? And if you just look at expected value by itself and you don't look at anything beyond just the expected value, you miss a lot in here, because what you miss is that the QQQ trade has a max loss potential of $3,000 versus the SPY trade on the other side has a max loss potential of $671. So the alpha, the amount of positive expected value that you're generating per unit of like real risk that you have to take to have that position on, is way better in the SPY position. So this is why we started talking about last time, this idea that you don't just want to take the highest positive expected value trades, because those highest positive expected value trades could also come, like this QQQ position shows, could also come with a lot of additional risk they're not factoring in. So we want some way to kind of rank apples and oranges and carrots and broccoli and all these things together. And so we kind of put that together inside alpha, which is what you're using. So brings us to today's episode. Today's episode really should be the next, again, big question that you're starting to ask yourself, or I hope you're asking in this like series of data and math and probabilities around options. And this question is, are probabilities valid only for a moment in time? People call this the moment in time question, problem, whatever it is. But basically this question that comes up, which is that if we're looking at a potential trade, like one of these trades where it says the probability of profit or the probability of max profit or the probability of max loss, all these probabilities, are those probabilities only there for a moment in time, or do they hold consistently? So if you were to reassess the probability of the position, does the probability of the position really hold for the majority of the time that the position is there as it's moving and as probabilities, of course, are shifting a little bit? Do these probabilities stay in control of the position essentially? Or, as some people would suggest happens, probabilities are kind of fleeting. Like there's a good trade and it's there for a moment, a fraction of time, and then it's gone forever, never to be seen again. And so what we try to answer is are these probabilities valid just for a fraction of a time, a moment in time, or do they remain constant and stable and relatively reliable, depending even through long periods of expiration cycles, right? So the big question is really, like I said, does the probability of profit, which is the pop, or the probability of max profit, you can look at it two different ways, maintain its predictive power throughout the trade's lifespan, which is a really important question that we want to get answered. And so this issue is obviously referred to as the moment in time problem. Now that is that probabilities are only valid at the moment that they're observed and immediately become invalidated as time passes. So this is what a lot of people think. A lot of people do think, especially new traders, even traders that have been around for a while, oh, the probabilities, they're just there for a moment in time, then they're gone. You shouldn't rely on them. You should trade on other things, whatever. But if we're going to use alpha and EV and all of these other tools in our disposal now, we also need to start incorporating probabilities, because all things being equal, we'd want to take the trade with a higher probability of success, right? So can we now rely on trades and their probabilities to start inform things like risk management and like how we position size and things that we'll talk about in future episodes? Or are all probabilities valid no matter when they're calculated, assuming that we have a robust model? So these are all questions that I hope to answer with you guys today and kind of show you the research that our team did around this. So on the back end, we took a look at over 1 million option trades that have been done on Option Alpha, focusing on 30-day to expiration. That's the longest period that we looked at because the data is just so massive. So the longest period we looked at so far for this study was 30 days, and then everything in between 30 days. 0 days, 1, 2, 5, 10, 20, 15, 26, 29, 23, all the way out to 30. And then we compared the entry probability of max profit. So the highest, easiest calculation one to do, which is the probability of max profit on these spreads, to the actual win rates that we observed on those trades, right? Seems pretty simple, pretty logical what we tried to do. Now, the goal again was to determine whether the calculated probability at the trade inception remains reliable across the various intervals. And so what we ended up doing is not just taking the entry and exit, we also calculated 11.2 million moment in time probabilities through the expiration of that position. So that means that for every position that we looked at, we took approximately 373 quotes per trade. So if we had a trade that was 30 days from expiration, we would assess the probability of that thing winning and determine it 373 times as it got closer to its final expiration. So we weren't just looking at the ends, if you will, like a trade 30 days out and does it go all the way to expiration? No, we were saying, okay, that trade that's 30 days out, now let's reassess the probability 29 days and 27 days and 23 days. And we'll just keep doing this at lots and lots of intervals throughout that timeline to see if the probabilities that are being quoted match up with what actually happens at the end of the day. And so really, this was a huge study, took a lot of time, a lot of processing power, and just a lot of data. I mean, obviously a lot of data and a lot of work on our team's end. So here's what we came up with, okay? This is one of the most important charts that I wanted to share with you guys here. And this is the predicted probability. Again, this is of max profit because it's the easiest one to calculate. Also very important to have the max profit calculated correctly versus the actual win rates. Now, what you'll see here is that we basically divided this probability graph, if you will, into 3 different chunks, okay? If you can see those visually, color wise, we did the light blue on the bottom. We did kind of the option alpha blue, the dark blue in the middle, and then we did the option alpha kind of green on the top. And all those basically were just basically 10% ranges focused around a median that we were trying to target, which was, in this case, the light blue on the bottom was about 55% win rate. That's that dotted line that goes across the middle of that first green or light blue section on the bottom. So what that's showing us is that those probabilities we targeted around an average 55% probability for trades that we were kind of looking at when we were slicing the data. So if you took a trade that on trade entry should have been the theoretical perfect probability of profit is and win rate was 55%, how far did it deviate from that actual probability that was quoted? So for example, here, right here around, call it like 2-3 days to expiration, the bottom left-hand corner. Can you guys see when I'm doing my mouse on the screen there? You just let me know in the chat there real quick. But on the bottom left-hand corner, I think you can. So the bottom left-hand corner here, you can see that if you were around 2 to 3 days from expiration and you had a probability being quoted as 55% win rate, you actually saw your win rate lower than 55%. So you can see how that the actual data here suggests that the true win rate on this quoted 55% probability was obviously lower at maybe 53, 52%. Now that may not be a big difference, but any differences that we see in probabilities as options trades play out could have a magnification effect over time. If you're basing all of your trades on 10% or 15% or 70% win rate, and they have differences, those differences magnify with time, right? So what we wanted to see is you want to see these lines generally as close to the target that we were shooting for in that range as humanly possible. So the closer we are to that target, the better off that we generally are. Notice up here in the 65% range, which is kind of dead middle of the chart here, we were shooting for a probability of success averaging around 65%. And you can see that we did get some that were significantly lower and also got some that were significantly higher that actually ended up working out better than expected. The target probability was 65%. It won at maybe 68 or 69%. So we're now starting to see this kind of fluctuation, this ebb and flow in these probabilities as they start to work themselves out over time. Now we get up to this highest range here, and you start to see we have a lot more variability in the actual data. Look at this range right here, which was about 10 days to expiration. You can see that we were targeting 75% win rate, and sometimes we had 68 or 69% win rate. So the difference or the delta between these lines, the spacing between these lines or the gap was greater the further out you went on the probability spectrum, if that makes sense. Okay. So you can start to see that we start to see, some similar rhymes and paths that these things start to take. We start to see some dips early, some consolidation, then some dips again around 10 days. Seems to consolidate, although a little bit lower further out we go around 15 days. And then we go out here to about 24 days, and you can start to see that that's really where we get to see the outperformance, I guess you could say, of a probability. So ends up working out pretty well. If I could, just from my own analysis, you guys might see this completely different, of course, as you go through here. But if I were just to take some information, just tell you guys what I see on this again, because it's just charting and you guys might see things differently, and please add them in the comments or let me know here if you guys see something different. But what I see in here is that generally speaking, when you look inside, say 10 to 11, 12 days to expiration, the probabilities are not as reliable. And that's broadly across the board. If you look at this, you can see that only a few probabilities, like 7 days to expiration, was even remotely more, predictive of the actual win rate of the strategy. But really anything inside 10, 12 days to expiration and lower, you weren't really seeing the stickiness of the probability that we would like to see. Meaning that if you saw a trade that was a 60% or 70% or 75% chance of success, it may not actually turn out to be that probability or that win rate when you let lots of trades play through. And this was more prevalent. This like disparity was more prevalent here. You can just see visually the volatility that we saw in the 70, 75% range, where the further you go out on the spectrum of high probability trades, the more likely it is that you're going to encounter these random black swan type of events, even inside 5-10 days. And that's going to throw things off. And so what this tells me and tells you, or should tell you, is that it's really hard, as we all know, and as many day traders find out the hard way, it is insanely hard to accurately predict where the markets are going to be or where they're going in a very short period of time. In fact, it's really, really hard to do it. It seems more like coin flips and random guesses and streaks and momentum and things like that, right? Things that the options models just don't accurately predict. So there's a lot of volatility, if you can see it here, inside of this 10 to 12 day range. It's probably not the range that you should be totally relying on for your trading. I will say, though, that if you are trading inside of that range, and let's say you like the 0 DTE stuff or the short weekly trades or whatever those are, build yourself an extra margin of error inside of your probabilities. Build yourself an extra margin of error inside of all of your calculations and how you set up your trades. If you're targeting and position sizing for something to win at 75%, it may only win at 70 or 68%. And that's a pretty big difference, a difference that notably could shift how you trade and your performance. Okay, if we now look at the other side of it, which is basically everything 15 to 30 days, we can see that this range is actually a lot more similar to the target probabilities or the theoretical probabilities when we look at the actual win rates. And so you can start to see that these numbers not only start to normalize, and just look visually, just like take a step back here and look visually at the left side, which is red, against the right side, which is blue. The left side, which is red, it's a lot more volatile. The lines are not like tight, they're not narrow, they're not right against that dotted line, which is our target. If you look at the right side, which is the blue area, you can see how the volatility compresses in these probabilities. And what that means is that pricing and actual win rates are actually more predictive the further you go on your DTE range. So if you go out to 15 days, you go out to say 20 and 30 days, you start to see a lot more of this, kind of compression here, which is a good thing. It's the probabilities actually end up playing out closer to what the expected outcome is. That means they're much more reliable as you go further out. Now, if you look at just broadly speaking, you can see that the 55 to 65 range is definitely a tighter range, broadly speaking, than this range up here. So if I actually let me just add another shape here just to kind of highlight this because I think it's so important. So if I add another one of these shapes in here, let me just duplicate this one. How come I can't do that? There we go. Okay, so if I add another one in here, and we just take a look at this range right here. So like this range right here, let me just format this so you guys can see this a little bit cleaner. We'll go orange. How about that? Bronco colors. Okay, so you can see in here this 55 to 60 range. Do you notice how this line is a little bit tighter across the data points that we have, right? This is a little bit tighter line. It doesn't have so much volatility outside of the target line, which is this dashed line in the middle. Now, if you go up here to the green line, this is further out on the probability spectrum. It swings pretty wildly across both of these target lines. Now, it's definitely better than this. It's a big improvement on what happens inside 12 to 10 days, but it's certainly not as tight and predictive as, say, 60, 65, 55% probabilities of success are. So what this again tells us, just if we're trying to look for what are the things that this is telling us, how can we use this in our trading, what this is telling us is that when you go further out in time, right, you go to a 15-day, 20, 25, 30-day to expiration trade, you also get better performance from the predicted probability going around the 55, 60, 65% probability range. Usually the 70 plus 75, 80% probability range, it's just so far out that you have to include some additional margin for error where it could be wildly different than the actual probabilities suggest. Now, in some cases, it could be better than expected. Notice here at about 23, 24 days, the predicted probability was 75 and the actual win rates were closer to 80, maybe 78, 79. That's good. I'm okay having better than expected, but I certainly don't want to encounter too many of these dips. I would rather see this line very, very tight in here, which would show us that the predicted probabilities are actually kind of matching up with where they should be. Now, truth be told, I'm normally a trader that was out at the 70, 75% range. That's where I kind of like to hang out. I actually hung out mostly in 70, but I've actually adjusted a lot of my trades down into the 60, 65% range. I do this whole YouTube series on this expected value portfolio that I'm kind of running and doing my journey on. And that's where I've basically put all of that. And it's because of this research that I've kind of adjusted that range down and made sure that I stick in this range here, kind of this orange box or so, 15 to 30 days and about 60, 65% probability of success. That's kind of where I want to park myself. Also happens to be where we have a lot of data and research on that as well. Okay. All right. So let's keep going here. Let's unclick that. All right, but Kirk, this is what you're probably asking right now, because I know you all and I know me, and I know I get really excited when I talk about this stuff. But there's probably a bunch of you that are saying, what the heck should I care about all this? Why should I care about all this crazy math stuff? And I know if that's you, you can say in the chat, you're like, all that looks cool, but why? I don't even know what to do with this. Why should I care about this? Okay. So here's why. And this is why you want to pay attention. This is why it's probably the best video you're going to watch or event you're going to be at today, because here's why it's so important. If probabilities remain accurate throughout the trade lifetime, then EV remains accurate as well. And this is really important because what this means is that you can rely on these numbers for both trade entry and trade management. And that really does mean that you can rely on these numbers. Now, obviously, we saw that some of the numbers are not as tight as we would like them to be, but it's not like we have a 70% chance of success and we get a 50% win rate, right? It's not like we're targeting a 60% chance of success and we get a 30% win rate. All of these trades, even the ones that had some more variability in them, like the 10-day to expiration trades, still were tight enough that you could probably trade with them. You just have to be aware that you need to have some built-in margins for error inside of your trading strategy, which you should by default, okay? So that's really what we're trying to get out of this, is that you should be able to rely on these as much as possible for not only trade entry, but also managing trades, okay? So let me stop sharing my screen. I'm going to switch over to a different screen here because I want to share some positions that I have in here. Hopefully that makes sense. That'll pop open here. There we go. Okay, so these are some live positions that I have. These are not paper trading positions. Yeah, these are live positions that I have. And I wanted to go through this with you because I feel like using some of this now, and just what I meant by saying you can rely on the probabilities even after the trade gets in, because this really will inform some of the ways that you take your trades, manage your trades, remove your trades, close your trades for assignment risk, things like that. So I want to go through a couple different examples of how you could practically use this inside of your trading here at Option Alpha. So first one here is, we'll just take a look at this one here. Actually, let's take a look at this one. So this one here is an SPY Iron Condor. I've been in this trade 20 days, okay? Actually, it doesn't really matter. We'll look at a couple of them, but it doesn't matter. But I've been in this trade 20 days. DIT is days in trade on Option Alpha. I opened this position on Thursday, November 2nd at 11:24 in the morning. So this trade has been open for quite some time. Now, this trade, when I got into this trade, was 60, 65% probability of success trade. And it was on QQQ, and we all know what's happened in the markets. They've blown up with all the Fed commentary the last couple of weeks, right? So now this trade looks like this. And this is the reality of trading. Sometimes you're going to have good trades, sometimes you're going to have bad trades. But this trade looks like this. Is a trade that, I don't know, can you guys see when I draw on my screen? I just drew in blue. I don't think you guys can see. No, I don't think so. Okay. But this trade looks like this. And this is why this chart is so powerful inside of Option Alpha, because it shows you your current P&L, like your total P&L, which I'm down $145 on this trade. And the probability that I get back to any sort of break even or max profit now is 1%. Do you guys see that on the chart? It's just 1%. So our range now at this point on this trade basically means that even though this trade has, I don't know how many days left this trade has, quite a few number of days left in the trade. What is it, 9 days left? It has 9 days left. There's zero chance that this thing is coming back around, right? I mean, it's 99% chance that we're going to lose on this trade. It's just gone too far, too fast at this point. Now, the value of doing this type of analysis is if you can't see this inside of your broker platform, your trading platform that you're using, you can come in here and import your position and take a look at exactly what the probabilities of that position are. And even though we've been in the trade for 16 days, and even though it's only 9 days to expiration, we know from our new research that we can rely on this number. Now, because it's 9 days to expiration, if you remember the chart that we just went through, the 10-day to expiration range for probabilities had a lot of variance, right? But it wasn't the good variance that it had. It wasn't suggesting that, hey, a 70% winner could be an 80% winner. So it's definitely not going to work in our favor. This position is all but assured to be a dead position. So what can you do with this? You can obviously close the position. You can actually build out automations that close positions like this that meet your criteria automatically, so that when you get to these types of levels, it will automatically start to remove the position. And a lot of traders, what they worry about all the time too is expiration risk and assignment risk of positions being assigned early. Well, ding, 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 this is probably one of those positions that might be assigned early because it's so far deep in the money, and it also has almost zero chance of turning back around. Okay, let's look at some other positions here. I'll just look at this XOP position. Been in this trade for about 6 days. That's the DIT, days in trade, here on Option Alpha. And you can see it still has about a 70% chance of success. So this is a good one to look at too, because if people are asking themselves, and if you ask yourself this all the time when you're trading, should I stay in the trade? Should I keep the trade open? Well, this trade has a $39 positive expected value. We're not quite at our profit-taking level yet, although we got a pretty high recently, right? It was up to 27% 5 hours ago, but it still has a 68% chance of staying inside of its break-evens. Now, I know that I entered this trade with probably about a 60% chance of success, 62, 63% chance of success. So this trade has increased its likelihood that it will be a winner, holding it for the last couple of days. The market's just kind of moved in our favor. So this is another good example of using these probabilities, I hope, to show you trades that you might stay in and trades that you might get out of or start to manage a little bit earlier. Let's look at some other ones here. So let's look at another losing trade. Let's see here. Okay, so here's a good one. So this one has about 13 days, or I've been in the trade for about 13 days. Expires in about 9 days. Oh, sorry, clicked off of it. Has about a 13% chance of reaching the break-even point. So it's not quite zero, but about a 13% chance of reaching the break-even point, which means that it's roughly an 86% chance that this thing actually goes out here and stays out here beyond this level. Now, is it going to be full max loss? I don't know if it's going to be full max loss or somewhere in between partial. But if you got into this trade expecting a 60% winner and you're holding on to it, and now you're looking at potentially a different trade with different probabilities, this again might be a trade that you start to roll off if you wanted to and start to remove the risk on this position. You can see that it's gone negative on its expected value. Not that it can't turn itself around, but this is just not one of the ones that ended up winning. All right, so let's go down here. Some other trades. Here's a newer trade. So this one has only been, actually I've been in this trade 19 days, not newer one, 19 days. It's got 23 days left to go. Because it's got over 15 days left to go in expiration, that means that we can be really confident on those probabilities. We don't have to build too much margin of error in there. And so it looks like it's still got about a 65% chance of success. And even though it has negative EV, this is one of those ones where maybe you make a judgment call and you say, look, it's got negative EV at this current moment, but I knew I got into it with positive EV, with positive alpha, because that's how I get into my trades. It still has a 65% chance of staying between its break-even points. Maybe that's a trade that I still hang on to and still keep in my portfolio. Now, again, if you don't have the ability to do this inside of your broker platform, make sure you just move your positions over. You can just import them right into Option Alpha, and then we'll do all the analysis like this for you, and you can do them here. As far as automations go, and this is what's really cool about doing this, is you can actually run automations to check this yourself. So we'll just build a new automation called check in the money probabilities. Or no, you know what? We'll call it check probability of max loss. How about that? And then what we can do inside of here is we can add this. Once I build this out, you can just add this to any of your automations that you're running or any of your bots that you're running. So I'm going to run through all of my positions. I'm going to loop through every position that I had. This is what the automation will do as soon as it starts. I'm going to repeat through each position that my bot has, and I just add this automation to any bots that I have. And I'm going to use decisions to check the position data itself. So I'm going to look at the position itself, and I'm going to look at, notice you can check all sorts of different types of criteria, but I'm going to look at the probability of max loss for every position that my bot has. So if my bot has a position and I'm now looking at the probability of max loss, I can check to see if the probability of max loss is greater than, say, 90%. And if it is greater than 90%, and the answer to this question is yes, then I can immediately tell the bot that it has basically authority, my approval to close the position. And right there, that simple set of decisions and automations that you can do means that any time that any position gets to a max loss of 90%, bingo, you can close the position, or the probability of max loss being 90%, you can close the position early. You can also do this on the opposite side where you start to manage positions that maybe have negative EV currently, but still have positive probabilities of success. The probability of max profit maybe is 60% or 65%. You can use this as a tool for management to get out of trades early that you don't need to be in anymore, or to stay in trades that you want to stay in with because the math and the numbers still generally work out and you don't want to exit the position early. Now, again, anytime that you run these in here, you can just run a simple test. We'll just grab one of our automations here that has some trades. I know QQQ does. Start this, and you can see that this is a call spread that right now is deep in the money, but the probability of max loss on this position is only 84%. It's pretty close to 90%, but it's not quite there yet. Still got a lot of time left until expiration, so it could keep monitoring this for me. And if that probability of max loss ever got to 90%, then it would go ahead and close and remove the position. So there's a lot of ways that you can do this. You can also check things heading into positions if you wanted to. So as you start to look at new opportunities, so that's what we call them, potential trades, you can look at new opportunities and say, okay, is the opportunity's probability of profit greater than some number like 70%? Only get into trades that are like that, or greater than 60%. And you can use bots and automations to actually start to analyze potential positions that you want to get into. So you look at XSP, you look at an expiration that's at least 15 days out, right? Because we don't want to do anything any shorter than that. And then you go in here and you say, okay, I want to make sure that that type of trade that I'm getting into has a probability of profit greater than 60%. Again, it's another easy slam dunk thing that you can do with your bots and automations to, again, make sure that you're managing your risk and using those probabilities effectively for your trades. Okay, so once you're good to go, you simply just save this one, save it to your library. It goes into your library inside of your automations. In this case, check the probability of max loss. It's unused right now in any bots, but you can just go into a simple bot, add it to your bot, and move on with your trading. Okay, so I hope that this was really helpful today to go through this. If you guys do have any other questions, as always, please let me know. Again, the goal of today's session was just to show you some of the data and research on how you can use option probabilities and how they actually are not valid for one moment in time, how they are pretty sticky, pretty reliable. You do have some fluctuations around that 10 days and sooner time period, but it's not like a 70% chance of success is going to turn into a 30% chance of success. It's not that far out. It's like a 60 turns into a 62 or something like that, right? So you just have to build in some additional margin for error. And then, of course, the further out you go in your probabilities, you start going towards 70, 75, 80% probability of success. It's just much harder to predict at that range. So you can think about today's session kind of wrapping up as saying it's really hard to predict where things go inside 10 days, and further out on the probability spectrum, the 70, 75, 80% probability of success wings get a little bit harder to predict as well. And maybe the pricing's not there to account for the risk of some of these little mini black swan events that happen during those time periods. So I hope you guys enjoyed this today. If you did, please let us know. And until next time, happy trading. Take care.